Ever wish you could just sit down with, like, a couple of big-time investors and kind of soak up their wisdom?
Well,
Well, that's exactly what we're doing
oh,
today.
yeah.
We're diving into a conversation between Porter Stansberry, a huge name in financial publishing, and his old friend Doug Casey.
Right.
And they had this like really fascinating discussion about financial newsletters and investing and what's really, moving the market these days.
Yeah.
And we've got all the good stuff for you.
Oh, these guys, they definitely don't hold back on their opinions, and they've got the experience to back it up, too.
Exactly. So let's just jump right in. They started talking about financial newsletters.
Okay.
And it kind of got me thinking, are these things just entertainment for like finance nerds, or can you actually find some like real insights there?
Hmm.
Stansberry seems to think that, high quality analysis is like super important, but not everyone agrees.
Yeah, I mean, think about it this way. Some people might read financial newsletters for the same reason they watch financial news channels,
Yeah.
just to kind of feel plugged into the market, get a sense of what's going on.
Yeah.
But the really valuable newsletters are the ones that go beyond just reporting the news.
Okay, so what should we be looking for here? Like, how do we separate the good from the bad?
Yeah, good question. Stansberry actually mentions another financial writer, Bill Bonner,
Okay.
who has this really interesting take on it.
Okay.
Bonner says that focusing on track records is kind of pointless
Really?
because, market results can be pretty random. Instead, he thinks the real value is in finding those insightful ideas,
Hmm.
the ones that challenge your assumptions and make you think about investing in a whole new way.
So it's not about like picking winners all the time. It's about broadening your perspective.
Exactly. It's like having a mentor who can help you see the bigger picture, understand the underlying trends, and make smarter decisions.
Now that makes sense. But where does Stansberry fit into all of this? He seems to be all about that, like really in-depth research.
Yeah, you're right. He aims for the same level of rigor you'd find from institutions like Morningstar or Value Line.
Wow.
He really believes that by doing that kind of deep dive analysis, you can build credibility and potentially uncover better investment opportunities.
So we've got Bonner, who's looking at the big picture, and Stansberry, who's digging into all the details.
Right.
It's like two different approaches to, finding value in the market.
Totally. And speaking of finding value, this brings us to another question they tackled. Is the stock market really made for the average investor?
That's something I've always wondered about. I mean, we're constantly told to invest in the stock market, but is it really that simple?
Doug Casey, Stansberry's friend, has some pretty strong opinions on this. He's actually really skeptical of public markets.
Interesting.
He argues that companies often go public for all the wrong reasons.
Hmm.
Maybe the owners just want to cash out, or maybe they're desperate for capital.
So it's not always about finding great companies with long-term potential. Sometimes it's just companies looking for a quick buck.
That's kind of what Casey's getting at. And he even goes a step further by saying he prefers private businesses because they're not as weighed down by regulations and costs.
So he's saying that sometimes staying away from all the craziness of the public market might actually be a good thing.
Yeah, it seems like he's advocating for a more nuanced approach to investing, one that considers a wider range of factors beyond just, stock prices and earnings reports.
Okay, so we're starting to get a sense of their philosophy on investing. But what about the current state of the market? Where did they see things headed?
Well, Stansberry seems to think we're in for a bit of a rough ride. He sees a downward trend in the markets, lower stock prices, higher bond yields, which, as you can imagine, has a lot of people feeling a little anxious.
Yeah, especially with everything else going on in the world right now, that does sound a bit unnerving. But is he just speculating, or is there something more to it?
He actually draws some pretty interesting parallels to historical market cycles. Like, he compares the current situation to the 1980s bear market, when stocks were trading at incredibly low price-to-earnings ratios.
Wait, how low are we talking?
Think single-digit PE ratios, a far cry from what we've been seeing in recent years.
Wow.
I mean, imagine buying a company that earns $1 per share for only $5. It really shows you how much sentiment can change and how drastically valuations can shift.
Yeah, that's a huge shift. But was the 80s the only example he used?
No, he also talked about Japan's market bubble in the late 1980s,
Oh, right.
where stocks were just ridiculously overpriced, trading at a crazy 90 times earnings.
90 times earnings, that's insane. What happened there?
Well, as you might expect, that bubble eventually burst, and Japan went into a bear market that lasted for decades. It's a stark reminder that even though markets can get super irrational, Those sky-high valuations don't last forever.
So is he saying we're headed for the same fate? Like, are we on the verge of a major market crash?
He doesn't really give a definite answer, which I think is important. You know,
Hmm.
he acknowledges the downward trend, but he reminds us that market cycles are notoriously unpredictable. He even suggests that a really strong bull market could still emerge, fueled by the same speculative forces that sometimes lead to bubbles.
It's like he's saying, hey, things could get bumpy, but don't rule out the possibility of a surprise turnaround.
Exactly. And this leads to another important factor they discussed, the role of government policies in all of this.
Okay.
Stansberry kind of gets into some maybe controversial territory here.
Okay.
He argues that the Biden administration's policies, specifically their approach to deficit spending and their potential reliance on modern monetary theory, could have some pretty serious consequences for the market.
Okay, now this is where things get really interesting. Modern monetary theory, or MMT, it's been making headlines lately. But for those of us who aren't economists, can you break it down for us?
Sure. Basically, MMT suggests that a government that controls its own currency can kind of spend without limits, without facing the same consequences as, like, a household or a business would.
So they're saying the government can just print money without worrying about the debt.
That's the basic idea, although it's a little more complicated than that. But Stansberry is really critical of this approach.
Okay.
He believes that if deficits had continued at like 7–8% of GDP under the Biden administration, we could have seen hyperinflation,
Wow.
which is that really rapid and uncontrollable rise in prices.
Now that's a scary thought. Hyperinflation can just wipe out your savings and make it really hard to plan for the future.
Exactly. And it just goes to show how much government policies can impact market stability. You know, regardless of your political views, it's clear that what happens in Washington can have a ripple effect throughout the whole economy.
So we've got these experts questioning the conventional wisdom about public markets, drawing comparisons to past market crashes, and warning about the potential dangers of government policies. It's a lot to take in. But I'm guessing this is just the beginning, right?
You got it. There's so much more to unpack here.
Okay.
But let's just pause here for a second and let all of this sink in. We'll be right back to dive even deeper into their insights. Don't go anywhere.
All right, welcome back. I don't know about you, but all this talk about market cycles and government policies is making me feel like I need to buckle up for a wild ride here.
It definitely makes you think, right?
Yeah.
And Stansberry and Casey, they don't shy away from the big questions either.
Yeah.
They even talked about, the possibility of the U.S. seeing an 89% market crash.
Oh.
Like what happened between 1929 and 1933?
Wow.
Or interest rates going way up to, like 15–20% like we saw in the early 1980s.
Okay, those are some seriously scary scenarios. Like an 89% crash, that would be, that would be devastating. But are these like real possibilities we should be worried about?
Well, nobody can predict the future perfectly, right?
Right.
But what's really valuable here is that they're looking at the factors that could lead to these kinds of extreme events, which can help us, understand the potential risks we face.
So what are they pointing to? What's making them so worried?
Well, as we talked about earlier, a big part of it is government policy.
Okay.
Stansberry argues that certain economic policies, especially the approach to deficit spending and the potential reliance on MMT, modern monetary theory,
Right.
could really increase the risk of these, catastrophic events.
So their concern is that too much government spending combined with this idea of printing money without consequences could lead to like runaway inflation and ultimately like a total market meltdown.
Yeah, that's the basic idea. Imagine like building a house of cards. It might look stable for a while, but even a little breeze could knock it all down.
That's a great analogy. It really helps to kind of visualize how fragile the whole system can be. But I gotta ask, are they being overly pessimistic here? I mean, we've heard these kinds of warnings before, right?
Yeah.
And yet the market always seems to keep going.
Yeah, that's a fair point, and I think it's always good to be skeptical. We shouldn't just blindly accept any prediction, even if it comes from, seasoned experts. But what I find interesting about their analysis is that they're not just throwing out, like, vague warnings.
Yeah.
They're actually backing up their concerns with historical data, economic theory, and a deep understanding of how government policies can impact the market.
So they're not just saying the sky's fallen. They're actually explaining why they think there's a chance it might.
Exactly. They're looking at patterns, analyzing trends, connecting the dots in a way that encourages us to really think critically about all the information we see every day.
Right.
They're not giving us all the answers, but they're helping us ask the right questions.
It's like they're saying, don't just trust us, don't just trust the headlines, like look at the data, understand the history, and then make your own informed decisions.
Precisely. And that brings us back to the idea of financial newsletters being more than just entertainment.
Yeah.
They can be really valuable tools for learning, for seeing different perspectives, and for challenging that conventional wisdom.
So where does all of this leave us? We've heard about the potential problems with public markets, the possibility of a huge market crash, the impact of government policies. It's a lot to process. What are the key takeaways for our listeners?
Well, I think one of the biggest takeaways is that the financial world is just, it's a complex and interconnected system.
Right?
There's no magic formula, no guaranteed path to success.
So no get-rich-quick schemes no matter what you see online.
Definitely not. It's really about understanding the risks, staying informed, and being prepared for the unexpected.
So it sounds like they're saying to take an active approach to investing, not just blindly following the crowd.
Exactly. And another important point they make is the importance of thinking for yourself.
Right.
They encourage us to question the status quo, challenge assumptions, and come to our own conclusions based on, careful analysis and thought.
So don't just take their word for it. Don't just take anyone's word for it. Do your own research, make your own decisions.
Exactly. And that's what makes this deep dive so valuable, right?
Yeah.
It's not about giving you a set of rules to follow. It's about making you curious and empowering you to explore the financial world with a more critical and informed perspective.
So it's like giving you a mental toolkit to navigate the market instead of like a map that might be outdated tomorrow.
I like that. And this is where it gets really interesting. If experts like Stansberry and Casey are, sounding the alarm about public markets, where should investors be looking for opportunities? Is there like a safe haven in this crazy, unpredictable financial world?
That's the million-dollar question. And I'm guessing they have some thoughts on that.
They do, and we're going to explore those in the final part of our deep dive. So stay tuned. The best part is yet to come.
All right, so we're back for the final part of our deep dive with Porter Stansberry and Doug Casey. We've heard what they think about financial newsletters. We kind of broke down their warnings about, potential market trouble. And now the big question, where do we go from here? If traditional markets are looking kind of shaky, are there any, safe havens out there for investors?
Yeah, that's the question on everybody's mind, isn't it?
Yeah.
And while, neither Stansberry or Casey say they have a crystal ball or anything,
Right.
their insights do offer some pretty interesting alternatives.
Okay, so no guarantees, but some, possible ways forward.
Exactly.
Okay, lead the way.
Well, remember how Casey said he really liked private businesses?
Mm-hmm.
That's definitely an area worth looking into.
Yeah.
He sees private markets as, less bogged down by regulations and often more in line with the interests of both, owners and investors.
So instead of riding the roller coaster of the public markets, we should be looking for opportunities in companies that aren't publicly traded. Sounds like we're going off the beaten path here a little.
Totally. It requires a different way of thinking,
Mm-hmm.
You got to be ready to do your homework and maybe have a higher tolerance for risk. But for those people who are looking for an alternative to the volatility and the, potential downsides of public markets,
Right.
it's definitely something to think about.
It makes you wonder if there's this growing trend of investors looking for a safe place to land in private markets. Are more people starting to question that old advice of putting all your eggs in one basket, the
Yeah.
public market basket?
That's definitely a conversation that's coming up more and more these days.
Yeah.
And it connects to another big takeaway from this whole deep dive,
Mm-hmm.
the importance of diversification. Remember how Stansberry and Casey both talked about how unpredictable those market cycles are?
Right.
What's hot today might be totally out of style tomorrow.
Exactly. Spreading your investments across different things, different sectors, even different types of markets can help you reduce risk and maybe even get better returns. It's that old saying, right? Don't put all your eggs in one basket.
Exactly. And diversification goes way beyond just stocks and bonds.
Yeah.
It could mean exploring real estate, precious metals, even cryptocurrencies.
Right.
Or, like Casey was saying, maybe even venturing into those private businesses.
So it's all about building a portfolio that fits your risk tolerance, your financial goals, your time frame. There's no one right way to do it.
Nope, definitely not.
And that's really where the value of this deep dive comes in, right? We've given you the insights, the historical context, those different points of view, and now it's up to you to take all this information and make decisions that work for you, your own situation, your own goals.
Couldn't have said it better myself.
So as we wrap up here, I want to leave you with one final thought to kind of chew on.
Okay.
We've explored the potential downsides of public markets and the advantages of looking for alternatives.
Right.
But the real trick, and maybe the most exciting part, is like figuring out how to stay ahead of the curve. How do you, the listener, identify those hidden gems, those up-and-coming trends, those opportunities that everyone else might be missing?
Yeah. That's the big question. And it's all about never stopping the learning process.
Right.
Read everything you can get your hands on, talk to experts, question your assumptions, and never stop looking for new information. This financial world, it's constantly changing.
Right.
And the only way to really make it in this game is to become a lifelong learner.
That's a perfect way to end this. Thank you for joining us on this deep dive. We hope you've enjoyed the conversation and maybe picked up some valuable insights along the way. Until next time, keep exploring, keep learning, and keep diving deep into the world of finance.